Today, we are introducing the subject of stock equity tax. We will go over the definition, the different types, tax implications, forms, and tax strategies. Stock equity refers to ownership-based securities issued by a corporation. When you buy stock, you're buying a small piece of a company. That ownership gives you the right to share in growth, profits, and decision-making through voting. Companies issue stock to raise money. Instead of borrowing, they sell shares to investors. This capital helps fund products, research, hiring, and expansion. The investors buy and sell shares in the stock market. You can earn money two ways when investing in stocks: dividends, which are cash paid to shareholders, and capital gains, which happen when you sell a stock for more than you bought it. For example, buying stocks like NVIDIA or Alphabet means owning a portion of these companies. As they grow, the value of your shares can grow too. Several instruments are included in the stock equity pool. Common stock has voting rights and is generally eligible for dividends. Preferred stock has fixed dividends, but usually no voting rights. Even though they behave like bonds, they are not debt instruments. Equity derivative instruments, which include stock options, equity compensation options, such as ISOs, ESPP, RSUs, and warrants, provide exposure to equity, even if they are not traditional shares. More detail is included on equity compensation in a separate video. Equity funds include mutual funds, equity ETFs, sector funds, and international and emerging market equity funds. They are not individual stocks, but they represent ownership in portfolios of equities. Dividends come in two forms. Qualified dividends, which have to meet the holding period test, generally at least 61 continuous days during a specific 121-day period, and are taxed at the long-term capital gain rates, meaning the lower tax rates. While ordinary dividends, also referred to as non-qualified dividends, are taxed at your regular income rate. When a stock is held for less than a year and then sold, the profit from the sale of the asset is a short-term capital gain or loss, and is taxed like your salary. It is taxed as ordinary income at marginal rate between 10 to 37% in 2025, based on your taxable income. When a stock is held for longer than a year before being sold, long-term capital gains apply, and are taxed at 0%, 15%, or 20%, depending on your income level. Most investors fall into the 15% bracket. Here's a simple example: buy NVIDIA at $200, sell at $800 after 1 year. That profit of $600 is a long-term gain and taxed at a lower rate. Here is another example. Selling Google or Alphabet after only 6 months would be short-term and taxed like ordinary income. Holding longer would reduce taxes. Tax timing for equity compensation types, such as ISOs, RSUs, RSAs, ESPPs, differ based on the following: grant date, vesting date, exercise date, and sale date. Then, the character of income can be ordinary compensation or capital gain. And there is other tax exposure to consider, such as payroll tax, FICA/Medicare, and special rules for alternative minimum taxes for ISOs, Section 83B election for restricted stock, and ESPP holding period rules. More details in a separate video on equity compensation. Higher income investors may also pay a 3.8% net investment income tax on investment earnings, including dividends and gains. The 3.8% NIIT applies to the lesser of your net investment income or your modified adjusted gross income amount that exceeds the statutory thresholds, which for 2025 are: single, $200,000, married filing jointly, $250,000, married filing separately, $125,000. Your broker reports your dividends, interest, and stock sales to both you and the IRS. You'll receive several forms at tax time. Form 1099-B reports proceeds from sales. Your broker will often report cost basis to the IRS and you get a copy. Use this to fill Form 8949 and Schedule D. Form 1099 DIV summarizes dividends and capital gain distributions from funds. And Form 1099 INT reports the interest accrued on your bank accounts. Form 8949 is designed to report proceeds from sales. The totals move to Schedule D, and then they flow into your main tax return. Equity stock compensation is reported on your W-2 and IRS Forms 3921/3922 filed by your employer. And brokers file statement of basis using Form 1099-B at sale. Your cost basis is what you paid for the stock, the purchase price. Your gain is the sale price minus that basis. Always keep records of your purchase prices. Wash sale rule disallows losses when you repurchase the same, substantially identical security within 30 days before or after the lost sale. In other words, if you sell a stock at a loss and buy it again within 30 days, your loss is disallowed. The disallowed loss is added to the basis of the replacement. If you gift shares valued at up to $19,000 per recipient, the federal annual gift tax exclusion applies. Gifts above that generally require Form 709 reporting. Stocks inside IRAs, Roths, or 401ks grow tax-deferred or tax-free. Trades are not taxable until withdrawal. Trades in Roth accounts are generally tax-free on qualified distributions. This can dramatically grow long-term wealth. To summarize, there are two main tax buckets for stock equity investing. First, income from dividends and interests are taxed as ordinary income, unless qualified. And second, there's capital gain or loss when you sell the stock. Short-term capital gain equal ordinary rates between 10% to 37% in 2025. And long-term gain equals preferential rates, 0%, 15%, or 20%. Here are some practical strategies to manage and optimize taxes. Hold stock at least 1 year to get long-term capital gains rates when possible. Simply waiting and holding stocks for more than a year can save investors thousands. Short-term trades are expensive taxes. They get taxed like paycheck income. Trading less can improve your long-term returns. Diversifying across different companies and sectors reduces risk. It prevents one stock's drop from hurting your entire portfolio. Tax loss harvesting means selling investments at a loss to offset your gains. When used carefully, it lowers your tax bill. Use tax-advantaged accounts such as IRAs, 401ks, or Roth IRAs for highly traded or high-yielding positions to defer or pay no tax. Putting the most active or highest growth stocks inside Roth IRAs or 401ks can eliminate or defer taxes entirely. Be mindful of mutual fund distributions. Buy funds late in the year, because buying right before a big distribution means you'll owe tax on gains. Consider tax-efficient ETFs for passive exposure to reduce realized fund distributions. Plan gifts of appreciated stock to someone who is in a lower bracket or to charity. Stock investing is one of the most powerful ways to build wealth. Learn the basics, diversify, stay invested, and use smart tax strategies to keep more of your gains. Thank you. If this information has been valuable and informative to you, please like, share, and subscribe.